Today also I'm facilitating both the recording as well as some of you all are joining today. That's absolutely brilliant because last week also I could not have my usual class on Saturday morning. So the similar possibility exists this week also. So I would be basically keeping the recording on for the other class enrolled students, and we will have the same interest rate consideration discussed at today's discussion also. And as highlighted in the last discussion as well as now in the today's discussion, please feel free to raise if you have any questions, any details that you wanted to clarify. If not, you can keep them noted. We'll be able to discuss in our next class session if you have any further details to be clarified. But interestingly, what we are heading in today's discussion is so-called risk and term structure of interest rates. Risk and term structure of interest rates. Again, one of the very, very important areas that you will come across in this course, and this will be very useful in terms of your knowledge base, apart from you are learning this for the examination. So as I said, I'll keep the option open still for you to raise any questions, any clarifications required. And the same would be again relayed through recording on Saturday morning's class. So the topic of risk and term structure is very significant simply because that applies to great extent in terms of majority of today's discussion in terms of where the interest rate structures prevailing, where the interest rate structures would go in the immediate near term, and across the medium term, how countries wanted to succeed based on tremendous challenges exposed by business cycle developments. But what is interesting here is you have already learned the supply and demand analysis of interest rates behavior. Okay, so we very much concentrated in our supply and demand analysis of interest rate behavior to look at one single interest rates. We looked at bond market interest rates broadly, and we said that those discussions, we kept all the other interest rates aside for easy understanding. Okay, but you know there are enormous number of different type of bonds even within, and other interest rates also available in the market, and these also differ significantly from one to the other, right? Even within bonds you find interest rates are different. Okay, and still, I mean, you can expand this to say that when you compare with other asset classes, these differences also again persist and also magnified with the different characteristics, different aspects that we try to learn in today's discussion. Okay, so in this section, we try to complete the interest rate analysis picture that we started over the last two discussions by examining the relationship of various different type of interest rates and compare them with one another. And why this is important is understanding why these interest rates differ from bonds to bonds would actually, within one same type of asset class itself, you might find a lot of differences in interest rates, right? So even if it is bonds within bonds, you find differences in interest rates. And this would help, understanding this would help businesses, banks, all stakeholders and private investors like you, if you wanted to invest, to make an informed decision in terms of how to make an informed investment decision, if not a portfolio decision, in terms of whether do you want to buy, hold, or for that matter, to make a decision in terms of selling these financial assets. First, we look at why bonds with same term to maturity. Term to maturity is no different to time to maturity. Okay, so duration. So we look at bonds with same duration, let's say 5 years to mature, but still they have different interest rates. Same 5-year maturity, same time to maturity. Other things being equal, we look only the time to maturity in this exercise and try to recognize why their interest rates are different. Okay, so the relationship among these interest rates is called risk structure of interest rates, where what you are discussing here is same type of asset class, let's say bonds, the duration is same, maturity period is same. We assume example 5-year maturity, but their interest rates are different. Okay, so to say that this relationship is analyzed, we called this analysis as risk structure of interest rates. Right? So the difference in interest rates arise, although the maturity is same, due to the factors of risk, liquidity, and tax considerations. Right? So we look at the bonds with same time to maturity, but their interest rates are different. And we call this as risk structure of interest rates. And these differences could occur due to risk, liquidity, and tax considerations. Right? So then, we also know bonds, if you take a financial assets, a treasury bond or a corporate bond, term to maturity. That means time to maturity or duration also affects its interest rates. Now, initially, under risk structure of interest rates, we looked at bonds with same duration, same time to maturity. But now what we are trying to analyze again is we relax the time to maturity. So different times to maturity, but same bonds with same characteristics, and try to understand why their interest rates are different. Even bonds of government of Sri Lanka, let's say treasury bonds, as the duration differs, interest rates also differs. Okay, so the relationship among interest rates on bonds with different terms to maturity, that different duration, is called the term structure of interest rates. So you first analyze risk structure of interest rates, where the same maturity bonds are looked at, but the differences in interest rates occurs due to risk, liquidity, and tax considerations. Then we look at same type of bonds where the risk, liquidity, and tax consideration remain same, but their duration, time to maturity, is different, and as a result, their interest rates also differs. And this is called term structure of interest rates. In this section, we examine the sources and causes of fluctuation in interest rates related to one another, and number of theories. We'll try to understand number of theories that explains these differences in interest rates. I hope it's clear for you what we are trying to learn and understand in today's discussion. right? So you can raise any questions you have. If not, you can write it down and share with me so I can follow up the questions that you have, as this would, to some extent, live for some of you all. At the same time, some others would be having this as a recorded discussion, recorded presentation on Saturday's usual class. So I keep that option open for you all to follow, and you can raise if you have any clarifications required in terms of what I'm discussing also. So we are trying to study the risk structure as well as term structure in today's discussion. So to understand, you have to take into account the same maturity, same duration in analyzing risk structure. But when analyzing term structure, you relax the duration. That means time to maturity. Time to maturity will be different. So the interest rates would be different. So we'll try to see what explains. There are theories that explains these fluctuations. We'll try to learn one by one and try to understand these concepts as much as possible in terms of clarity. Right. So the risk structure. What we are looking at is bonds with same maturity, but they have different interest rates. Duration is same, 5 years, the example. Right? So then we look at the so-called default risk. The probability that the issuer do not honor the interest payments due and or the maturity due as per the timelines of the bond in consideration. Please remember, default risk is, it's not only the interest, that is the coupon payments, as well as the maturity payments, but not only that, remember, the timely payment also matters. So anything do not honor on a timely basis, again, a default. Not only the coupons, but also the principal. So we look at the bonds with same maturity, but probability of default risk. Then liquidity. Ease at which you can convert your assets into most liquid form of cash. How quickly, without incurring time as well as cost, transaction cost. So the liquidity measures how efficiently you can convert your financial assets into cash form. So to say that the higher the liquidity, higher the risk consideration, the interest rates would differ. Then the third element we look at is tax considerations. There are bonds which has withholding tax. There are bonds whose coupon or the capital returns, capital gains are exempted from tax considerations. So you find, although the bonds are now same in duration, that is time to maturity, but the characteristic of default risk, liquidity, and tax consideration would have differences in interest rate applicable for these bonds. You see here, and I remember we discussed detailedly about credit rating. Okay, so what you are basically seeing here is differences in terms of rating corporate AAA bonds. AAA. That is AAA. Corporate AAA bonds. These are red color chart. Then corporate BAA bonds. Those are given in blue, light blue color chart. Then you also see US government long-term bonds, which is a mix of green and blue. It looks in terms of a blackish green, right? US government long-term bonds. Then you see green state and local government, that is municipal bonds, right? So the duration of these bonds are same, but interestingly, risk, liquidity, and tax considerations are different. When you look at any country, in that country's government issued bonds are considered as default risk-free. Those bonds are default risk-free simply because the government in that country could print money and honor its obligation, or impose taxes, raise taxes, and honor its obligation. There are repercussions when you print money, when you raise taxes, there are repercussions. But generally what you are trying to say is the central government issued bonds are highest in credit rating. As a result, they are called default risk-free. So in the eyes of investors and credit rating, these are AAA rated. So why corporate AAA red color and government's AAA rated, although rating is same, still the government's long-term bonds are lower interest rate than corporate AAA rated bonds, right? So there are other elements also play a role here, although rating is usually same when it comes to AAA rated bonds, corporate bonds, because government bonds also AAA rated. But then the element is the default probability of government is even more lower, and people call it default risk-free, whereas corporates could still go bankrupt, although they are now AAA rated. They can't print money in the first place. Second point is they can't impose taxes. They can raise prices of whatever they produce, but then it's a choice of consumers whether to consume or not. So that's a risk. But still, those also rated very high in rating scale, almost the top, right? But still they have to pay little more in interest rates than governments, because the probability of default at least prevail in corporate, although it's rated high. And then you look at corporate BAA. That is also investment grade. But compared to corporate AAA, corporate BAA is higher in default probability, right? So the interest rate that they have to pay for investors is greater. That means higher than corporate AAA, and actually much higher than the government. But you can see here, generally the government rates remain lower. Let's see here in early 1900s, and then again in recent years. But all throughout from 1930, late 1930s to early 2000s, even in US, more than the US government papers, US municipal papers, municipal bonds are less in interest rates. The reason for why US municipal bonds are much more lower in interest cost is simply because they had tax exemptions. Investments in municipal bonds had tax exemptions, whereas investment in US government bonds had some tax elements to pay, withholding tax. Because most of the foreign governments, foreign fund managers, foreign investors invest in US government bonds. So the US government can raise a certain amount of tax income through having a very small but effective tax rate for US government papers, whereas state and municipal bonds, local government bonds, they have given tax exemptions. So the rates at which US government municipal bonds were trading until recently lower than the government papers, much lower than corporate AAA, corporate BAA bonds. So what you are basically seeing here is in recent times, US government bond again become much more sought after and effectively most sought after financial assets in the world. And their interest rates are very much lower. And today, the 10-year US Treasury bond is only about 1.25%. Right? So that's today's market. So you can effectively see the default risk, right? Liquidity and tax consideration that makes the bonds with same duration, but their interest rates to be different. And to some extent, these being pooled and factored by credit rating. So the credit rating of higher nature, that means high investment grade, carries lower interest rates. Credit rating of lower nature, that means junk and speculative bonds, as you have seen in the credit rating chart, carries higher interest rates. And then from a perspective of default probabilities, higher the default risk, higher the interest rates. Lower the default risk, lower the interest rates. Higher the liquidity, lower the interest rates. Lower the liquidity, higher the interest rates. And then you have tax consideration. If there is tax applicable, it tends to pay a higher interest rate. If there is no tax exemption, that could carry a lower interest rates. So these are the elements that you see drives these interest rates to be different. And you effectively see the risk structure drives these interest rates that we discussed to be different, as we have seen in that chart. So the probability that the issuer of the bond is unable or unwilling to make interest payment or pay off the face value at maturity is known as default risk. You see, he is unable from one side or unwilling. Sometimes they can still settle, but they are unwilling due to various reasons. For instance, recently the Argentina, right? They were not settling some of the bonds matured issued by the government of Argentina simply because they felt the vulture funds, speculative fund investors, they are trying to take Argentinian papers and then keep the government for ransom, right? So the government of Argentina did not honor, and there were cases in many countries, in many courts. They have imposed penalties and things like that, but still they did not honor those because they simply felt those vulture funds buying those bonds at deep discounted price. And when Argentinian government wanted to buy them at those closer to those prices and honor off, so they are not paying the face value then. They also pay a discounted lower price. But those buyers are not ready to sell. They were not selling. They were holding on, expecting at maturity they will pay the face value. So the Argentinian government did not honor that. And there were a lot of arguments over this. But what you have to understand here is default could happen not only because you are unable, but also due to your unwillingness to honor interest and maturity payment on a timely basis. Okay, so then the conclusion here is US Treasury bonds are considered default free. Government can raise taxes, print money, and honor. So the risk premium, okay, you find in terms of default risk free financial asset and other financial assets is the gap between US Treasury bonds and, let's say, US corporate bonds. So the risk premium of US corporate bond is positive. That means the interest rate of US corporate bond is higher than US government bond because there's a positive risk premium spread between interest rates on bonds with default risk, that is corporate bond, and interest rates on treasury bonds, that is default free. Okay, so to understand the elements here, you find here in the previous slide, from here, let's say 1975, the government papers interest rate is 6%, whereas corporate BAA, blue chart that you are seeing, where the interest rate is about 10%. So 6 and 10, the difference is 4%. So the spread is 4%. That's the risk premium corporate BAA bond has to pay over US government paper. So the risk premium again differs from country to country. The US paper and then another country's paper, for instance, Sri Lanka's. Sri Lanka also has its international sovereign bond trading in international capital markets. At the time of issue, right? So we also have seen when US 10-year US Treasury interest rates were around 1%, Sri Lanka government issues 10-year papers at about 7%. So you effectively have a risk premium of 6%. Right? So that's a risk premium. Over and above a benchmark, often the benchmark is US government long-term papers, long-term treasury bonds. And when you look at within your country, Sri Lanka, for instance, take treasury bonds of 10-year. The interest rate is about 7.5%. Right? So if a corporate issues a 10-year bond in Sri Lanka, the interest rate, let's say 11%. So the risk premium there is 7.5 minus 11, or 11 minus 7.5. It is 350 basis points. That is 3.5%. So the risk structure, the default probability would drive your interest rates to be higher. And higher the risk premium, the default probability is higher, the interest rates are higher. Okay. Any questions before I move to the next aspect? You can raise if you have any questions to be raised here, or you can write it down and share with me so I can also explain to the effect for your understanding. So, but interestingly, what you are simply seeing is now the default risk. So as a result, risk structure would detail some bonds, although the duration or the time to maturity is same, their interest rates are different. Right. So you see here, corporate bonds versus treasury bonds, US treasury bonds. So corporate bonds has the default probability, whereas US treasury bonds are default free. Okay, so what happened here is a first step that you are seeing here, an increase in default risk. The corporate bond market, where the corporates are facing difficulties, let's say even COVID probability, right? So the demand for corporate bonds shifts to the left. So lower demand, right? As a result, the equilibrium would be at a price which is lower than original equilibrium. What it says is lower the price, higher the interest rates. So with the prospects of default risk, the demand shifted to the left, and as a result, prices decreased. That means interest rate increased. And effectively what this transpired is the people who moved out from corporate bond markets preferred to invest, if not preferred to invest and consider US Treasury bonds. They have moved to the US Treasury bond market. So the demand for US Treasury bonds increased. The demand curve shifted to the right. As a result, US Treasury bonds prices have increased. PT2 from PT1. PT is price of treasuries. PC is price of corporate. Okay. So the demand for treasuries, DT2, is now greater. As a result, price increase. Higher the price, lower the interest rates. So what happened here is the price of US treasuries increased, interest rates have reduced, whereas price of corporate bonds have declined, interest rates have increased. So the gap between interest rates of corporate bonds and interest rates of US treasuries would define the risk premium. Let's say because of the price decrease, interest rates of corporate bonds have increased to 8%. Because of the price increase in treasury bonds, the interest rates of US treasury bonds have reduced to 2. So as a result, 8 minus 2, the risk premium is 6. So the gap. Okay. So lower the interest rates of treasury bonds and raises the rate on corporate bonds, thereby increasing the spread between interest rates on corporate versus treasury bonds. That is the risk premium. So that's what you are seeing here. Okay, you can again try to draw some other elements. Let's say imposing taxes on investments in US treasury bonds. So that would push the demand curve to the left. And some of the demanders who buy US treasury bonds either move to the corporate bond market or to the municipal bond market. So the demand for municipal bond or corporate bond would increase. That means their demand curve would shift to the right. So the prices would increase, interest rates would decrease. And what effectively would happen in such a circumstance is risk premium will come down, narrowed, risk premium become narrower. Okay, any questions?
So why does the tax affect the demand in this case?
Can you repeat? Can you repeat the question again?
So now you said there is a tax imposed on treasury bonds.
Yes.
Why does it affect the demand and not the supply of treasury bonds?
Yes, right. It's a good question. Why the tax affects the demand? So if the tax is imposed on issuers, that would affect the supply, right? So when the tax is imposed on issuers, what that effectively means is same quantity they wanted to raise by issuance of bonds now require with the tax some additional more quantity being supplied by the issuers. So then the supply curve would shift to the right in such circumstances. So when the demand is same, right? So demand curve is here. Supply shift to the right means the prices would further decrease. That means interest rate would increase if that tax is imposed on suppliers, issuers. But generally, a tax of withholding tax, investment tax, that's been imposed on the investors, that means the demanders. So that's why it shifts the demand curve. Actually, demand curve would shift to the left. So effectively, if this is the original demand curve, red line, if there is the tax imposed on investment returns of treasury bonds, so the demanders would reduce the demand for treasury bonds. Then the demand curve would come towards this blue side. And effectively, the equilibrium would be somewhere here. That means the prices are lower, interest rates are higher. So part of these investors would go to other bonds which does not have a tax application or tax exemption. For instance, in Sri Lanka, if you look at 2012 budget, there is a withholding tax exemption for corporate bond. Corporate bond listed in the Colombo Stock Exchange. So there were a lot of corporate bond issuances during that year, because government bonds had a withholding tax of 10%. Right? So the people, investors, based on to whom that you are imposing the tax, would make the call whether it's affect the demanders or suppliers. Generally, if there is no specific reference to that the tax is applicable to suppliers, if not issuers, generally any tax that you refers here is imposed on demanders, if not investors. So as a result of that, when you see that you had to pay additional tax on your investment of treasury bonds, you would reduce investments in treasury bonds. So reducing investment in treasury bond means demand curve shift to the left. That means the prices reduce, interest rates increase. Okay, that's clear?
Yes, sir, thank you.
Any other questions? Right. So you have seen the effect of when these demands change, what happens to the effectively when the equilibrium prices and as a result the equilibrium interest rates changes, what happens to the risk premium? So either risk premium expand, if not becomes narrower. So it depends on which direction the equilibrium prices move. And then you see the rating. I think I have touched upon this rating in one of our previous discussions. But you are studying now the credit rating. Credit rating is effectively, okay, an evaluation. One call it independent evaluation, but it's an evaluation of the timely payment ability of both interest and capital of an individual, firm, or a debt security. Maybe that firm or that individual could have multiple debt securities issued. So they look at each and every at different points of time. This could be individual, firm, or for that matter, even a country, sovereign. So when it comes to sovereign, then it becomes a sovereign credit rating, if not sovereign bond rating. If it is a firm, it's that firm's bond rating or credit rating. So the credit rating agencies, there are a number of agencies in the world, but there are three major credit rating agencies. Those agencies rate international as well as domestic issuances by individuals, firms, as well as governments. And these three agencies are Moody's, S&P is Standard and Poor's, and then Fitch. And the highest rating often across these agencies in terms of symbols is AAA. Moody's refers to this AAA, A, double A, capital A and simple two double A's. Still it's AAA, but both S&P and Fitch, they go by the AAA, all capitals. And what it symbolizes from those rating references is prime, if not maximum safety. So if you are investing in a AAA rated asset, there is no probability, if not, there is very little probability that they would not honor their obligations. So you are reasonably assured of your investment return. But it's not necessarily the case all the time. There may be circumstances, even investment rated agency could go bankrupt. This happened during financial crisis, right? So you probably heard of Lehman Brothers, one of the biggest investment banks in the world. They were in investment grade on September 14th, 2008. The following day, they applied for bankruptcy. So this is during financial crisis, that many things could happen. Similarly, other highly rated agencies, institutions during that period. But what you are basically seeing here is the rating agencies look at the probability that these agencies honor their obligations on a timely manner. So then they represent some rating scales. The highest rating scale is AAA. And then it comes lower in terms of AA1, AA minus, then AA, sometimes AA1, 2, 3, single A plus, single A minus, and B, AA, if not triple B. So what happens here is, as you move down this scale, C, D, you become effectively a junk grade. So when you see the bonds and the ratings are below BB, if not Ba1, which is called non-investment, everything above BB plus, that means BBB minus and above, are investment grade. Those are investment grade. Highly assured of the obligations being honored. You go down this, the increasing probability of the risk that they would not be able to honor. So effectively you are seeing, as you go down this ladder, the risk is increasing. So the rating agency symbolizes Moody's, S&P, and Fitch. In terms of these rating definitions, what's the rating of a firm, individual, or for that matter, a country, and also within this individual firm or country, different issues at different times. They do a rating for the issuer, that's a country rating. And also they issue that issuances. The country could issue number of securities during different times of one particular financial year. So then they rate that also. So effectively, these rating scales signifies the level of risk associated with the issuer or that issuer's issuances. And this rating, as I said, is an evaluation of timely payment ability, because you don't talk about a payment at the maturity or payment at coupon points. You rate at the time of issuance, and subsequently you rate that issuer. So the issuer's ability has weakened compared to the time of his issuance in the market. Okay, so then people behave differently, interest rates behave differently, but they rank these probabilities, the default probabilities, and rate highest to lower in terms of scales, starting from AAA and all the way go down to C's and D's, where the default probabilities get higher. So what you are seeing here is this rating is based on the credit history, right? It's like somebody's credit history. So you have a better credit history, there's a possibility that you maintain a higher rating, right? You have a very, very sought after, never defaulted, right, credit history. You always honored your obligations on time. So you have a very high credit history. Then your financial position, present financial position, how your income, okay, how your expenditure. Because of that, you will see your balance sheet, how your balance sheet strength, right? They look into all these things. Then you issue to the future. So what's the future outlook? Whether you have, although your present financial position is weak, let's say due to COVID and things like that, but you seems that you will have a more probability that you will recover and start your economies growing, your income would grow, the businesses would expand, the likelihood that you will have more revenue, and as a result, the deficits would come down. Then your future income looks positive. So they look at all these things. And on top of this, they also now analyze ESG. ESG, environment, social, and governance considerations. That is also the fourth point now. Okay. So the rating agencies look into the aspects of credit history, present financial positions, likely future income, and ESG considerations, climate change related developments. Now, environmental problems, social problems, the governance structures. So they look at all these things, and they have a rating marking structure. And through this marking structure, they derive at scores, values. And these values would differs from one scale to the other. Based on these values, they infer where your ratings status is. And for this, they collect, store, analyze, summarize, as well as interact, discuss on a regular basis with rating agencies and the policy authorities, firms, individuals, all being kind of, continuously looked and evaluated for information and actual market consideration. So this rating process is another very important yardstick in today's financial markets, particularly in bond markets, in terms of representing the level of risk of a issuer as well as that issuer's issuances, and then they give you a rating scale, and that scale would define whether you are sitting on a particular level. Ultimately, that would be in kind of, represented in price levels, where the prices as a result of that, where the interest rates in terms of your financing probability. So the default risk to great extent being looked after in today's context through rating structures. Any questions? Right. So you see these rating probabilities, right? So at the same time, you also now see, apart from this default risk that we were talking in terms of risk structure of interest rates, there are two other considerations. One is liquidity. As we discussed, the ease at which an asset can be converted into cash. Okay. So if you can easily convert your asset into cash, that means that carries a high liquidity. You don't need to waste time. You don't need to incur additional cost. If the cost of selling a bond is huge, that means that bond is not liquid, right? So from another perspective, number of buyers and sellers in a bond market also define whether the bond market is liquid or not. More buyers, more sellers means more market participants, right? Then they have different of views about the financial asset. That is good. Everybody is in one side, everybody is in selling side, means everybody would try to sell. Then as a result, prices would decrease. Nobody is there to buy. But if you see a lot of participants, some want to sell, some want to buy, some view this firm is good, some view this firm is bad, some see this firm's future prospects of earning is greater, some think no, is passive. If they might think some other firms are good. So there are buyers, there are sellers in the market. So when the number of buyers, number of sellers remain greater, the liquidity of that financial asset also greater. You can easily transact, right? So it is also, again, when it comes to other financial assets, if the location is good, right, neighborhood, access, other facilities are greater, price of those assets are higher. That means interest rates is lower. The higher the liquidity, lower the interest rates. So you can easily convert that assets into cash. Therefore, you don't have much cost in selling a bond if the liquidity is high. If you have more participants, more people in the market, then you find those bonds carry a high liquidity. Then the third element, tax considerations. Right, as I was mentioning, interest payments on municipal bonds were exempt from federal income taxes in US, and as a result, municipal bonds become popular and sought after by US domestic investors because they can have some exemption from their tax filings. They don't want to pay taxes of interest returns of municipal bonds. But that's not the case with US government bonds. They have to file taxes and they have to pay some amount of their interest income as taxes. So then the no tax instrument is more favored than an instrument with tax implications. So that would translate into prices. So more tax would have to pay additional income tax or whatever tax. So as a result, a higher interest rate would be requested by investors. So high interest rate means lower prices compared to tax exempted, let's say, municipal bonds in US case. In Sri Lanka, you don't find municipal bonds, so you don't have much of a familiarity, if not a comparable possibility. But in most of the OECD, if not advanced markets, you have municipal bonds, very much popular among investors. Right? So you know now default risk, liquidity, tax considerations, these things drive interest rates to be different, although the time to maturity is same of a bond. This is nothing but the risk structure of interest rates. So the explanation in terms of taxes, where you see municipal bond versus treasury bonds in US case, tax-free status of municipal bonds shifts the demand curve of the municipal bonds to the right. As a result, the new equilibrium PM2 compared to PM1, what you are seeing is the higher prices. Higher prices mean lower interest rates. When you see that municipal bond has a tax-free status compared to treasury bonds, where you don't have a tax exemption, you find the demand is somewhat shrinking. So as a result, DT2 from DT1, you see a new equilibrium price, PT2. If that's a lower price, that means higher interest rates. So what you are basically seeing is, with the result that municipal bonds end up with a higher price and a lower interest rates than the US treasury bonds. So this with the tax application. So that's why sometimes the governments are so keen to say that the tax policies are consistent. They don't change the tax treatment every year, that's become more frequent. So then the uncertainty, even though you don't have taxes now, there may be the possibility that the market would think they would impose next year. So they would factor that into their demand or investment decisions. Even the suppliers would take that into account. So it's better to see more consistent policy framework. So that would invite investors to take a more long-term view on investments. Right. So risk structure, we have now learned. So we are moving into term structure. Any questions? If you have questions, you can raise. If not, you can also type it and share with me so I can follow it up for clarification. So what you're basically seeing is the risk structure now, but we will now move into term structure, where we would relax the maturity consideration. So you would not see the term to maturity same now. So we would get into that in terms of analyzing. So the term structure of interest rates, now we see bonds, let's say treasury bonds. identical risk, identical liquidity, and tax characteristics. Municipal bonds, everything else being taken into consideration, the characteristics are same, municipal bonds. But still, treasury bonds, municipal bonds, corporate bonds, the risk, liquidity, tax characteristics may be same among those asset classes. Municipal bonds, you are comparing municipal bonds only. Treasury bonds, you are looking at treasury bonds, because you can't compare treasury bonds and municipal bonds, then tax considerations are different. But what we are now seeing is identical characteristics, but time to maturity is different. Then as a result, you will find their interest rates also different. Five years, 7 year, 8 year, 10 year, 20 year, 30 year, different maturities of treasury bonds. Although risk of a treasury bond is same across all maturities, liquidity characteristics generally same, not necessarily same, because there may be elements of other considerations that come into play. Tax characteristics reasonably same, because we don't know 30 years down the line the government in power would impose a tax or not. That's a different ball game. But that's why I said consistency in tax treatment is important. Then investors are attracted to invest in longer tenor papers, right? So we look at these identical characteristics, but we differ the duration. And as a result, you find the interest rates also differ. This is what term structure of interest rates try to analyze, right? So you might go to Google and search yield curve dynamics and type my name. You probably find papers published in international journals, because I have done reasonable research and published with some of my professors when I was doing my postgraduate studies with respect to term structure of interest rates. So you can still kind of, explore some of these writings in terms of availability of yield curve dynamics and different country experiences, different country perspectives, how those yield curves differs, and what explains those yield curve different shapes, different theories. That's been studied and analyzed in those papers. And particularly in terms of US, Sri Lanka, and Japan. So these were the countries I have analyzed in terms of some of those papers. You can have some of those for your reading if you Google it and you come across some of those papers. So the term structure of interest rates, where now identical characteristics of risk, liquidity, and tax consideration, but interestingly, the maturity is now different. So in this exercise, you will come across the yield curves, right? So yield curve is a plot of the yields on bonds with differing terms to maturity. That means different time to maturity, but same characteristics of risk, liquidity, and tax consideration. So you draw a plot of different maturities, interest rates at given point of time. So that exactly what I'm trying to say is, even sometimes I listen to people who come in media or write in media, they try to refer yield curves to time series yield behavior from 1932. We were looking at some of those charts like this. Yeah, this is a time series behavior of yields of different assets with different characteristics, but duration is same. But what they are simply saying, they try to say this is a yield curve. This is a yield curve. This is completely rubbish. It's wrong. Yield curve is you take identical assets, let's say US government bonds, and then you have, let's say here the maturity, 3 months, 6 months, 1 year, 2 year, 3 year, 5 year, 10 year. Duration is here. Interest rate is here, no problem. But then what you are doing is this line at a given point of time. 2 year is 5%, 3 year is 5.2%, 10 year is 6%. So you can figure it out whether the yields are upward sloping given the maturities that we are looking at. That's what we are trying to now study. Characteristics are same, maturities are different. So that means you pick one type of asset class, let's say treasury bonds, and try to see with the time duration changes where the yields are. And yields are for a treasury bonds in this example that we are trying to understand. For a given moment of time, you can figure it out where the yields are. Yield curves could change from 1 minute to the next, because you could see new news would change the investor's perception. So the yield curves slopes could be different from 1 minute to the other. It may be downward sloping, it may be upward sloping. Downward sloping is inverted, right? If not, it's flat. What is interesting here is you try to understand upward sloping, where long-term interest rates are greater than short-term interest rates. Longer the duration, the interest rates are higher. There are theories that explains why that long-term interest rates are higher. We will come to those stuff. The upward slope, you are climbing a ladder, staircase, sorry. So you are climbing the staircase, you find shorter tenor rates are lower, medium tenor are higher, long tenor are somewhat higher than medium tenor. You are going up. From one step to the other, in the staircase, the gap is same, but in the yield curve, it's not the case. Maybe somewhat steeper at one point, somewhat moderate at another point, but general direction is upward sloping. Longer the duration, rates are higher. Shorter term interest rates are lower. So when you look at a flat yield curve, there is no difference. Short and medium term, long term interest rates look same, right? So why that we will explain. Then you see inverted. Inverted means short-term rates are higher, long-term rates are lower. That is negatively sloping, not upward, but effectively downward. Inverted. Short-term rates are higher than long-term rates, that is inverted. Normally, the long-term rates are higher than short-term rates, that is upward sloping. That's the yield curve you generally see in most of the market, most of the time. Even the shape of these yield curves are effectively signaling where the economies are heading in terms of market expectations. Very, very important information for policymakers. So the yield curves could be upward, could be downward sloping, that is negative if not inverted, or flat, based on where the rates of short term and long term in terms of same characteristics, financial assets, but duration is different. This is the term structure that we are studying, right? So then facts that a theory of the term structure of interest rate should explain. There are theories. Those theories try to explain certain facts in terms of understanding why these yield rates are different. And effectively, there are calculations, there are mathematics, there are economics, econometrics, all involved in try to prove some of these, establish some of these explanations. But we would not get into those in this course. We will generally explain from general characteristics. If anyone you is really interested to learn those stuff, you can take postgraduate studies in economics or monetary economics, macroeconomics, and study even financial markets. And we will not get into those. But we will try to explain the facts that these theories in terms of term structure is explaining. But the first point here is interest rates on bonds on different maturities move together over time. It's like waves, right? It moves together. If the short-term interest rates are increasing, long-term interest rates are also increasing. If short-term interest rates are decreasing, long-term interest rates are also decreasing. They are moving together. The yield curves could lift up, could lift down across different time periods, because in a yield curve, what you are simply seeing is the interest rates of different maturities are plotted. So those yields, 2018 at, let's say, X level, 2019 at Y level, somewhat higher, and in 2020, again at a lower level. So across different maturities, short to long, the rates have behaved across these levels. So somewhat a close movement across different time periods, different maturities. So that's one fact these theories try to explain. Then the second fact, when short-term interest rates are low, when you say low, it could be X%, Y%, Z%. That's not going to change your perception. Compared to long-term interest rates, short-term interest rates are low, irrespective of the interest rate number. If it is 10% now, short-term interest rates are low and they say 10%, then the long-term interest rates could be definitely higher than 10%. If short-term rates are low, you are referring to 1%, then the long-term interest rate needs to be more than 1% at that point of time. Okay? So when we are saying short-term interest rates are low, they conclude that the yield curves are more likely to have an upward slope staircase. When the short-term rate, first step is always at the start. That means at lower level. So when you see that lower level, you have to climb up. So the medium to long-term interest rates are higher. And as a result, if you draw the yield curve, it slopes upward. The same explanation says when short-term rates are high, that means you start from the top stair of the staircase. So you are looking from top to downward now. So the short-term interest rates are high means long-term interest rates needs to be lower. So if you plot them in a yield curve, what it explains is yield curves are more likely slope downward, and downward means inverted, negative slope. Upward means positive slope. So positive yield curve, upward sloping when the short-term interest rates are low. When the short-term interest rates are high, the negative sloping, inverted yield curves. That's the second explanation. Then the third explanation they try to recognize and explain is yield curves almost always slope upward, irrespective of other consideration. You see here the so-called time uncertainty consideration. Longer the duration, greater the uncertainty. Many things could happen. As a result, you need to pay some additional premium to invest long. So the short term, you are reasonably certain. Long term, you are somewhat uncertain. So you expect yield curves to slope upward. So these are the three facts the theories of term structure tries to explain. First fact is interest rates of different maturities move together over time. Short term, long term, increasing at certain point, decreasing at certain point. They all move in a kind of a collaborative fashion. Then the second fact is when the short-term interest rates are low, yield curves tend to slope upward. Similarly, when short-term interest rates are high, yield curves tend to slope downward, negative, inverted. Yield curves, third fact is almost always slope upward. Time factor is considered. So this is what we are trying to now explain through 3 or 4 major theories of term structure of interest rates. Any questions? Any questions before I move on with the explanation? Right. Right. So we look at 3 theories, but the third one we would again link with the so-called preferred habitat. I will come to that explanation. The first and most widely studied and explained theory is expectation theory. So what, from another perspective, expectation hypothesis. Right? So that explains the first 2 facts. That is, yield curves move together. And second fact is, when the short-term interest rates are low, upward sloping. When short-term interest rates are high, downward sloping. That explanation. But not the third. Always moves upward. No, not that. Segmented market theory That explains third fact. Moves always upward, but not the first two. But the liquidity premium theory that combines the two theories that we saw now and explain all three facts. So it's in a way more modern in terms of looking at all these facts into consideration. So we will try to get into these and try to elaborate in terms of how best we can understand. Right. So you find here movements of interest rates on US government bonds, but different maturities. You see here a time series analysis of US government bonds. 3 months treasury bills, 20-year treasury bonds, 3 to 5 year US treasury bonds. They call it notes, treasury notes. This is different time periods, and these are identical characteristics because all are US treasury securities. Risk, liquidity, and tax considerations. What you are seeing here is, let's say, early 1990s, if not, if you draw a line here, short-term rates are lower, medium-term rates are next, long-term rates are higher. So this, if you draw a yield curve here, because this is not a yield curve. That's why I said sometimes the pundits, they come and explain these things in different media and explains. They call this a yield curve, and this is not yield curve. This is a time series behavior of interest rates. So if you want to see a yield curve here, vertical line, draw and pick these points and then draw. Short-term interest rates are low, long-term interest rates are high. So here you are seeing an upward sloping yield curve.
So in this case, yield curve will only be a vertical line, is it so?
At each point of time, and even time I'm taking here should be a single day, or even within that single day, single minute, because yield curves are that dynamic to change. But effectively, you can call it N period, N 2020, N 2021, N 2010, right? So at a point, okay, that's the yield curve.
Okay.
So you see here, it's upward sloping because short-term rates are lower, long-term rates are higher. But then you see here, early 1980s, short-term rates are higher, long-term rates are lower, downward sloping yield curve. Economic reasons are there. I will come to those and explain to you as we move on. Why short-term rates are higher? Why long-term rates are lower? That market expectations, market build expectation immediately with these yield curves. And even these short-term interest rates could have been due to policy interest rates. Central banks increase the interest rates to fight inflation. So today's inflation is high. So they wanted to contain inflation by making cost of finance high. So they increase the interest rates. So your ability to consume or demand goods become lower, and you also get motivated to save because opportunity cost of holding money is greater when the interest rates are high. So what it means is you fight inflation now. That means future interest rates are lower. So anybody investing 5 years, 10 years down the line, he would not see today's inflation. future inflation is lower because you are fighting today. So his expectation of longer tenor interest rates are lower. So it's a downward sloping yield. Here you see generally upward sloping. Here you see a downward sloping. But there are times where interest rates of all three maturities also same, flat. Let's see here in 2000, early 2000, like all interest rates are on each other. Here again in 1990s, again on each other. So there is no difference between short to long. So the flat. So the yield curves again can be explained by looking at this time series interest rate behavior chart of US government treasuries, right? By taking a vertical points of each of these, you can actually explain what type of a yield curve exists at that point of time. Right? So you can see this, and we will try to elaborate with different theories that try to explain. So the expectation theory or expectation hypothesis, what it says is interest rates on a long-term bond will equal an average of the short-term interest rates that people expect to occur over the life of the long-term bond. Okay? So that means what it says is the long-term bonds interest rate is nothing but the average of short-term interest rates that could occur during the lifetime of that long-term bonds. So indirectly, if you think the long-term is 2 years, right? 2-year interest rate is nothing but the average of 1-year interest rate of today and 1-year interest rate of 1 year from today. 1-year interest rates today is one period. 1-year interest rate 1 year from today is the second period. So average of those two is equal to 2-year interest rates today. We will come to numbers also and try to explain that. So in this circumstance, what it explains is bonds of one maturity, right? Buyers of one maturity do not prefer bonds of another maturity simply because effectively they are holding return-wise something of indifferent in nature. Because what you will simply see is you buy a long-term bond today, simply because you simply look at the rate of that long-term bond from the perspective of short-term bonds that would occur across the time duration of that long-term investment. That's your today's expectation. That's why it's expectation theory. This could change with developments tomorrow, day after, 1 year from now. Then you change the expectation and that would drive the market preference, and as a result, the price of short-term versus long-term. Every time you see an arbitrage over this equation, there is opportunity over this long-term rates are nothing but the average of short-term rates. That's breakdowns. The demanders or the buyers would act upon those and bring back the equilibrium. That's what make people to buy one bond over the other. Okay, so in this explanation, what you have to understand is the investors believe bonds of different maturities are perfect substitutes. Short term to long term are perfect substitutes because they don't see short-term interest rates would differ from long-term interest rates if you look at the duration of that long term in terms of possible short-term investments. Here, with a very simple example for you to easily understand. Let the current rate of 1-year bond be 6%. So today you are seeing 1-year interest rate of treasury bonds is 6%. Then you see same 1-year bond next year, that means 1 year from now, to be 8%. One year 6, next year 1 year is 8. So then the expected interest rate of buying a 2-year bond today is nothing but the average of 1-year interest rate today and 1-year interest rate 1 year from today. So that is 6 plus 8 divided by 2. So this is 7%. So what you are basically seeing is the 2-year interest rates today should be 7%. If it is more than 7, you would not buy 1 year. You will go and buy 2 year today. And as you buy, more demand for bond in the market. What happened to the bond demand curve? Shift to the right. When that shift to the right, what happened to the equilibrium price? Increases. When the price increases, what happened to the interest rate? Decreases. As I said, if you see the today's 2-year bond is more than 7%, assuming these facts here, you demand 2-year bonds. As a result, price increases and price will converge to equilibrium 7% to make you are indifferent between buying a 1-year bond versus 2-year bond today. So this is the expectation theory. If it is less than 7, you will not buy 2-year bond. You will go and buy 1-year bond. What happens when you start buying? 1-year demand will increase. As a result, 1-year price will increase. 1-year interest rate will decrease. So then you become equal with 2-year interest rate. So that's how the market dynamics makes you indifferent between one bond to the other. That's the expectation of market participants. They drive these expectations to build that long-term bonds rate of return are nothing but the average of short-term rate of returns occur during the life of that long-term bond. We explained that with the very straightforward example here. If a 2-year bond is nothing but a 1-year bond today plus average of 1-year bond today plus average of 1-year bond today and 1-year bond 1 year from today. So that's what it's explained here. Okay, any questions? Before I head to the equation, right, of how this 1-year bond expectation theory explains here is IT, I is interest rates of time T, today's interest rates. Please take IT is 1-year interest rate, 1 period bond interest rates today. Then IT plus 1 expected, right? You don't know what's the 1-year interest rate 1 year from now. That's why it's expected. The interest rates on a 1 period bond expected for the next period. After 1 year, what would be the interest rates of 1-year bond? That's what it explains. So I2T is nothing but today's interest rates of 2 period bond. So effectively what you should be highlighting here is I2T equals IT plus 1E expected average divided by 2. That's what 7% equals 6 plus 8 divided by 2 in the previous slide. So that's what you are seeing here. Right? So effectively 1 plus I2T times 1 plus I2T minus 1 is equal to nothing but 1 plus 2 times of I2T plus. These are all simple mathematics. I'm not trying to kind of, detail this out, because you try to kind of, see that the equation itself validates the point, but then you see here this component. See this I2T square, this component. The expectation theory says is very small. Yes, it's small. There's no argument with that. But this component, expectation theory, tries to keep silent, because interest on interest. So first year's interest and that interest, possible interest return in the second year, they kept silent and conclude that 2 period bond is nothing but 2 times I2T, today's 1 year, because if you get interest rates of 1 year, today's 1 year, today's 2-year interest rate is 2 times of that is what you get for two period investments today, right? So effectively he tries to kind of explain it in that way by keeping this component silent. That's what does not explain the third point. If you see this being taken into equation, that this theory also would have explained the third point. So to some extent, we were trying to kind of discuss that in our papers, but we are not getting into too much of explanation of those things. So effectively, expectation theory, okay, is what in terms of today's 1-year interest rate times 1-year interest rate 1 year from today minus 1 is the investment return if you invest $1 today. So you simplify this equation. 1 times 1, 1. 1 times IT is 1 IT. Then 1 times IET plus 1 is the same. So then you see IT times this and this. You see each point being multiplied with each other. So you basically see minus to minus set off, plus and minus set off here. What is left with is this component. So this component, they call it extremely small. Then you get what? IT plus 1-year interest rates today, this IT is 1-year interest rates today, plus 1-year interest rate expected 1 year from today is equal to 2-year interest rate, 2 times of 2-year interest rates today. So that's exactly the point we are trying to say. So this 2 goes to the other side means that's the average if you write into an equation. So that's what they have done it here. So we have shown you the 2-year interest rate equation, that is nothing but 2 times 2-year interest rates today equals 1-year interest rates today plus 1-year interest rate expected 1 year from today. So the equation is simplified by bringing this 2 to the other side. That means we are taking the division. This is multiplication, so division. So that's average. So this is for 2 period bonds. So you can expand this equation to n periods. So you can go on. I2T is 2 period, INT is n period. So INT, and likewise this goes on to the, let's say 10, n is 10 means this is the last one is 9 point here, right? So effectively what you are seeing is long-term interest rates as per the expectation hypothesis is nothing but the short-term interest rates that could occur during the lifetime of the long term that you are investing. So it is nothing but the average of short-term interest rates. So when you see this average varies and one side is heavier than the other, the market would act upon that opportunity and then clear any imbalances. So make you indifferent between one period to longer periods in the equation. So that's the expectation theory. As a result of this, expectation theory explains, okay, why the term structure of interest rates changes at different times. Yes, when the expectations differs, the rates differ, so it changes. But interestingly, what it explains is when one side changes, the other side also changes. That means interest rate across the board move together over a period of time. If short-term increases means long-term also has to increase. Otherwise, what happens is, right? So everybody will start coming to short-term. So then short-term will come down. So it moves together, right? So the other explanation here is when short-term rates are lower, it's very straightforward, right? So you expect next period short-term interest rates to be higher to make long-term interest rates equal. Okay, so this explains the second point where sloping is upward when short-term interest rates are low. When short-term interest rates are high, it's the opposite. And this does not explain this always upward slope. That's the third fact. I'm not trying to take this third point here, but that also can be explained by that small component that we took out from discussion in expectation theory. So this is ideal point for me to stop and start the discussion from segmented market theory in our next discussion. Any questions that you have from what we discussed? If not, we can stop at this point. Please go through what we discussed up to now. That's very interesting. You have to at least get the message across in terms of the expectation theory. long-term interest rates are nothing but the average of short-term interest rates. You just try to see 7% equals 6 plus 8 over 2. That explains everything there, right? So that would set you in terms of how to see segmented market theory, so-called liquidity preference, and then of course preferred habitat. I said fourth theory, but those are very much same in explanation. So we'll come to those in our next discussion. So I'll stop at this point and hope this recording will be again you can listen through if you are interested in our usual class on Saturday. So we'll try to have very much a similar arrangement next week also, because 14th or the 13th Saturday also I might have some official engagement in morning hours, but we'll see. If a requirement arises, we'll have a similar session as well as recording being played for the following week also. So we'll start at this point in our next discussion. And thank you very much and stay safe. Thank you.